Yeah, this is Dr. Long in the 6th edition. Um, this is, and I'm honored, people call this the iconic graph. I get requests all the time, and I freely give it out. Updates on it. We update every 6 months on that. Stocks, bonds, and bills with the real returns, as you can see. I divide it in 3 periods. I mean, actually, just very arbitrarily. There's the Coles Foundation period, the Coles data from 1871, and I'm going to talk about that. And then there's the data up until the CRISP series, a set of research and security prices, which I guess is transitioning to Morningstar or has, and then the post-1926 series. It is total real returns after inflation, including reinvested dividends or interest, capital gains and losses, as the case may be. There's a couple of things that are striking about it. One, the stock line, which is the white line, and there's a regression line through there. Since it's on a logarithmic scale, of course, the straight line represents a constant real return. And it does seem to cling to the trend line quite a bit. That's called mean reversion. It's a big debate. Well, the question is it settled? Is there a mean reversion long term? Now, short term, it looks like a random walk. Fama and Samuelson, actually, Paul Samuelson talked about it earlier. And he actually believed it was a random walk in the long run. But more and more data comes in, it appears to be a mean reverting stochastic process. Bonds, not quite so much. Actually, when I published the first edition of Stocks for the Long Run, which came out in 1994, based on 1992 was the article and data that I had done. So that's more than 30 years ago. I'm not the first to claim the mean reversion of equity returns. Actually, a number of other economists had suggested it, but the more data we got, and the further back, and I went back another, period, it looked more and more international looked that way also to some extent. In fact, I found that bond returns actually were almost mean averting rather than mean reverting. But a couple other things I wanted to point out about that. The white line, which is total real stock returns, all those wiggles are the great bull and bear markets over time. In 1929 doesn't look much, even though it's a decline of on the S&P 80%. I think it's 88 on the Dow. Some of these other declines don't look much. The bubble over here, they seem to sort of fade into the upward thrust of the equity returns over time. The equity premium, if you measure it as the difference between stock and bond returns, is 3.6%, quite wide, a number that people have difficulty explaining. We're going to go back to that. If you measure it by bills, since short-term is a little less than long-term, you even get a wider one. I'm not going to debate whether one is better than the other. A gold 0.8% over 223 years. So 0.8%, 0.8 percentage points above inflation. That's it. However, it's interesting. We were on the gold standard. That's why they're the same until we were off the gold standard a little bit during the Civil War. Of course, but then we really went off. Roosevelt devalued the gold. You see the jump there in the 30s, and then it stayed, and then Nixon Willie went off the gold standard. Now, if you take the slope there, because it's the slope that represents a term, I didn't do that, but I just want to. It's really important. It's been a 7% real return since Nixon released the price. Not as good as stocks, but not much worse. So it's sort of, people say, well, what is the real return? It depends. Now, after it went way up to $800 an ounce, everyone wanted it. Its real return since then has only been 1% a year. Now, these are long-term periods, but the beginning and end points can make a big difference. So when you're a lot of people write me, "Oh, Dr. Siegel, you said gold's not good, but since 2000, it has, beat stocks." And that sounds long, like it's 25 years. Yeah, but from, 1980, it's gone much longer. It's gone 1%. So, beginning points and end points are really important. Um, and literacy of the Dower, this is interesting because once we were on the gold standard, there was no inflation virtually, obviously, because we're on the gold standard. And then look at what the Dower could buy. It starts out with 1 real. Now it buys 0.377 real. So that's a 20, almost 28, 29 times depreciation. It buys less than a nickel of what it could used to buy. So the total cumulative inflation is like 3,000% since Roosevelt went off the gold standard, let's say in 1933. Do you notice that has had zero effect on the world return to stocks? 3,000% cumulative inflation has had no effect on real stock returns. What is the lesson of that? Stocks might not be a good short-term hedge against inflation, but you'd be hard-pressed to find a better long-term hedge against inflation. You can't even tell that there's been 3,000% cumulative inflation, zero before and 3,000 later, and it's had no effect on real returns on stocks. Of course, stocks are claims on real assets, so theory tells you it shouldn't. In the short run, though, it does, because the Fed tries to control it, raises real rates, et cetera, and so on. There's accounting change, et cetera. But in the long run, all that washes away. So there's a lot of lesson. I could go on, but I don't want to because I want to talk about a lot of other things. And I said endpoints matter. This is not quite right because I asked Ed last night. His article ends in 2019, right? The data. 2021 marked the biggest bull market in bonds in history. In fact, 2021, I started looking back, is the biggest bull market in any broad asset class in world history. 40 years, 1981, 16% 10-year bond, got down to 57 basis points in 2021. Now, would that produce a great capital gain? Yeah, it absolutely does produce a great capital. Not so real good since then, Ed, but, you're going to tell us a little more about that. Now, I did point out in his article that the bonds looked a little weird there. The first part up to 1871, bonds don't do badly. In fact, they kind of match, and then they kind of fall behind later. Listen, Ed has done a fantastic job. I mean, he has gone down into the weeds of those early stock returns like no one else did, with a better job, almost orders of magnitude, I think, than anyone did. I highly respect his work, showing me that I probably did overstate the real returns on stocks, often due to banks, which I have a strong feeling on because I can look at them out of my window in my condominium in Philadelphia, the first bank of the United States and the second bank of the United States. I'll talk more about that later. So maybe stock returns aren't quite as good. Maybe bond returns aren't quite as good, though. I don't know. As you put in your article, maybe you'll talk about that. Maybe they are closer then. There's a question of, since that first data series, we have 150 years of further data, which I don't know, basically is unchallenged. I think maybe Ed put a few little changes in it, but nothing, I think, significant. So a fundamental question is, should you change your view on stocks and bonds as a result of what happened between 1802 and 1871? Ed will tell us. You also might make up your own mind on that. Let's talk a little bit about equity risk premiums and a little bit about probably the most famous guide of ever, and FAJ, Financial Analyst Journal. Um, I had to be careful with the title here because Bob Shiller is my best friend. 58 years of really deep friendship. And I was saying, uh-oh, it's not giving the right signals. What's going to happen? Um, so I had to think of a title. What's all wrong with the CAPE ratio, all this? So I decided the Sure CAPE ratio, a new look. I thought that that was sort of neutral there. Um, that was not easy. This article was not easy to get in FHA. There was a lot of opposition, but thank you very much for putting it in. What I pointed out here on the lower left, basically, is they changed the definition of earnings, um, including capital gains and losses, basically, um, which, of course, really changes the CAPE ratio. So what I have here, this blue dotted line, is real per share reported earnings on reported. We debate between uh, uh, reported earnings. During the financial crisis, that big dip downward was much worse than the reported earnings dip of the Great Depression of the 30s. And that's because they changed the definition. So I said, oh, the CAPE ratio is going to be horribly biased because the CAPE ratio is 10 years of past earnings, and it's going to contain this crater over here. So until that crater moves out, it's going to be way, way underestimating what stock returns are are going to be on that. We had a lot of debates. Um, John Author, it was called the Clash of the Cape Crusaders, Bob Shiller and Jeremy Siegel. We had debates all over the country about what was actually going to happen. Um, they're huge fans, and I mean, there's some very important insights in the Cape ratio. And I believe valuation does matter. Not that it doesn't matter. I just thought here it was getting wrong signals. But the Economist magazine absolutely falls in love with the CAPE ratio. I love the Economist magazine. It's very learned. I have had print editions for 40 years. They have reviewed my book. They didn't like it, but they love the CAPE ratio. I think it's mentioned like 3,000 times and 10 covers. So when I read this article that appeared in the FAJ, I finally got a mention. Well, not a mention, a slathering criticism. First time. They said Professor Siegel thinks that reported earnings are not accurate. That was not what I said. I said they changed the series upon which Bob based his CAPE ratio, and that would be big distortions. Totally missed the point. I actually wrote a letter to the editor, and they did print that letter to the editor. But, oh, boy, they really it's a thought that by the way, there is big problems with reported earnings. We're not, that's another issue, but that was not the issue I was talking about. But there was a lot of John Campbell said, Jeremy, you wouldn't have mean reversion without, some sort of valuation pressing in, worked with Bob, and he was absolutely right on that then. Okay, so in March of 2014, the CAPE ratio predicted a 2.2% real 10-year return. I predicted 5 to 6. So Rob said, Jeremy, you think that the CAPE ratio is way too pessimistic. I really strongly disagree with you. So he thought he was willing to bet that the CAPE adjusted, I'll tell you what CAPE adjusted stock returned to be less than 5% real. He said, Jeremy, put your money where your mouth is. I took that as a challenge to take a bet. So I said, all right, Rob, what do you want to put? $50,000, $75,000 on this? So I'll never forget Rob's response. Where are you, Rob? There you are, Rob. I wonder. Rob said, Jeremy, who do you think we are? Graduate students? 75,000? Penny in? Minimum 1 million. Woo. I'd never bet $1 million on a stock market prediction before. But it was interesting that what Rob specified, I'll tell you, what does CAPE adjusted mean? Well, he said he had to adjust it for what the CAPE ratio was. He said, if it flies up like 2,000, crazy like that, I don't want you to be right just on return. So it's got to be adjusted for the CAPE. But that, I think, gave me a really special advantage. Wow, because the CAPE ratio is way overstating what the actual PE was because of the pits of the great financial crisis, which I didn't think was going to happen in the next 10 years at all. So I really thought, seriously, Rob, you had probably gone to 5 million instead of 1. But as I thought of 5 million, I thought of a headline in 2024, 10 years later. It was a bear market, and there was a big headline in the business section of the New York Times. Jeremy Siegel, author of Stocks for the Long Run, declares bankruptcy. That scared me. $1 million I could take. 5 million at that point, maybe it wouldn't have been much to Rob, but that was a lot for me. Well, it's really, what was interesting, so the 10-year realized stock return was 10. Now, CAPE adjusted was lower, but still well above our minimum. So it was so complicated. When you transfer $1 million, you have to adjust the CAPE, the gift taxes, and all sorts of stuff like that. So I made a suggestion, and you can do that too with your friends when you bet. Have each one of them give it to your favorite charity, and then you just get the tax deduction. My charity was the Renovation First Bank of the United States, which has been closed for 65 years. It's a beautiful bank, but it fell into disrepair. And there's a private organization, nonprofit, not going to go to the government, to renovate it. It will be open for let me get this right, semi-quincentennial. That's the 250th anniversary. That's next year. I urge you to come to Philadelphia and look at it because it'll be ready by then. So thank you, Rob, for helping finance that. Thank you. Very nice. What are we? What do we do? What about today? All right. What kind of valuations do we have today? Well, we have the Mag 7, NVIDIA, Microsoft, Alphabet, Amazon, Meta, and then Tesla. Now, take a look, the forward price earnings. Theoretically, it is forward, by the way. I know we don't know forward, so people take back often, but if you do pure theory, it is forward. There's 34, 33, 30, 27, 33, 21, and then there's Tesla at 221. Tesla's like an option. The Mag 7 is 32. The Mag 7 X Tesla is 30.6. The whole S&P is 23. X Mag 7 plus some other related techs is only 18.6. Whoa. That's still bigger than the long run average. By the way, there it is, that X-Tech's historical PE ratio compared to 2000. I'll talk about that in a second. Now, I put forth in the third edition of Stocks at Long Run that the 1516 that Shower found, as many still claim, is the right long run PE is the wrong one. I don't have a lot of time to go into that. I never wrote an academic paper on it. It has to do with the tremendous reduction in transaction costs to get a fully diversified portfolio. When we say 6.5% was the realized rate of return of, let's say, up till 1950, do you think the average person got it? No. They couldn't afford it. They couldn't afford to diversify that much. Transactions cost, brokerage fees, all the rest. Today, we can index for 1 basis point or less. The world couldn't be done. Well, what happens when transaction cost goes down and an asset becomes more liquid? It goes up in price. The 6.5% that the market got before from a 50 PE ratio is more. 5% they probably got, and that would have been lucky. Well, you get 5% today exactly with a 20 PE ratio. Okay, so 20. Well, market is higher than 20 now. Including Mag 7, it really isn't. X the Mag 7 here, it's still kind of toward the top of a range that was the last 30 years, but not that much. Nothing like, this is my last slides. They told me 5 slides, so I tried to do this. 5 slides. This is probably my most famous op-ed. Was gutsy. Big cap tech stocks are a sucker's bet. Lead op-ed in the Wall Street Journal. Wall Street Journal wrote me, they said it was the most commented on op-ed of the decade. March 14th, it came out right at that peak of NASDAQ. Whoa. Well, look at the P. This is the Mag 7 of that day. Cisco, AOL, Time Warner, Oracle, Oracle, Sun Micro, EMC, JDS, Uniphase, Qualcomm, and Yahoo. That was it. Look at the PE ratios. Hundreds, average of 200, not 30, 35, nothing like today. I just showed that it could never grow into those valuations, that valuation. Could you grow into a 30 or 35? Of course. Could you go into those valuations? No. I have one more thing to it's sort of interesting. You see, NASDAQ was 5,000. Now and then it went down to what, about 1,200? Went down 85%. There's this natural thing. Oh, this was the craziness, and this, of course, was right. Well, just a minute. NASDAQ was 5,000 at the crazy peak of 2000. What is NASDAQ today? Does anyone know? Almost 25,000, right? Almost 25 times full. What kind of compound rate of return is it from 5,000, the crazy peak, to today's level over the last 25 years? Should be able to do that in your head, right? 6% a year, double, what's the rule of 72? 6% a year, that's 12 years every double. So 24 years goes up 4 times. You're actually going up 4.5 times. So we've done 25 years. So maybe 6.5% compound rate of return on the index. Throw in 1% for the dividend. How about 7 to 7.5% compound annual return from the crazy peak of 2000 till today? Ooh, not bad. Beating all bonds and beating all fixed income instruments. Not as. I wrote an article on bubbles, the most overworked term ever. Let me give you just a couple of, and then I'm ending, thoughts. I want to expand your mind on this. You're all familiar with the great paper of Mara Prescott about the equity risk premium. Why is it so high? I think it's going to be lower. By the way, if you want to know the truth, I think they're probably going to be about 5% real, maybe over 20, 30 years. And tips are what? 1.8, say 2. It's not quite there. So 5, 5.5. That's 2.5%. That's lower than historical. Don't confuse lower equity returns with lower equity risk premium. Some people seem to do that. It's the difference between the two. Real bond returns are going down as well as real stock returns. Although real stock returns will go down more than that, but still maintain pretty healthy. I read an article about bubbles. I said, in a way, you could say that the only sanity comes to investors at the peak of the bubble. And people say, what are you talking about? It's sort of like the market is in continual depression with prices 50, 75% or lower, less than we economists say they should be. It's only at the peaks where people see the light. But then the depression returns and they sink down to the level they always were. Well, what's short stock? Well, let's assume the real rate is 2. What did Merriam Prescott think that the equity risk premium should be? Anyone remember that? Famous 85 article that spawned over 1,000 subsequent articles to try to explain it? How many basis points? 35. Given the economic fluctuations, long-term behavior, equity returns should be 35 basis points. Well, whoa, okay. So if real returns are 2%, and equity returns should be 2.35%. Oh, what the PE ratio does that mean? 1 over 0.235%, right? That's the way to do it. What's that? 43.6 equilibrium PE ratio, according to the equity risk premium literature. Now, we could criticize it, but interesting thought, is it not? In fact, well, we all remember the crazy book, Dow 36,000, didn't we? Of course, the Dow is closing on 50,000 now, but this was written back in 2000. Who was it written by? There's one of the co-authors, our friend, Kevin Hassett, who was chairman of the economic advisors under Trump 1, National Economic Book number 2, one of the 3 major candidates for Fed chair, number 3. I know Kevin very well. I campaigned with him for John McCain back when. I don't think he's right for that job, but yet Kevin wrote me after I wrote Saxo, and he said, after Merriam Prescott, he said, it was like scales drop from there. Once people realize how stable stocks are in the long run compared to bonds, even more stable, the equity premium will disappear and the Dow will go to 36,000. And that's what the book was based on. I wrote back a criticism saying I wish people might think that rational, but the equity premium would disappear, of course, or virtually disappear. But that was perfect. He did exactly that calculation for that book. And of course, the market crashed from 2000. Everyone assumes the crash price is right and the top is wrong. Anyways, I wanted to give you food for thought, some ideas for you to think about. I'm honored that you invited me here, and I cede the podium to Ed. Yeah, thank you.
All right, April. Mark. So I'll be dealing strictly with the realized equity premium today, the one that we can observe in the past. I have no clue what the equity premium will be over the next 10 or 20 years. Perhaps when I finish my talk, you will agree. So we start with Jeremy Siegel's work. He is the pioneer of multi-century research. What I've done here is I've taken the chart from his 5th edition. I've used a little whiteout. Yeah, I'm about that old. And, to really keep the focus on stocks versus bonds, because that's going to be my definition of the equity premium, stocks over bonds. Now, I'm going to dispute parts of Jeremy's history, but let me make it very clear. We have no dispute about the area in the red square. We are using exactly the same data. It's Rogers' long bond data, and it's the crisp total stock data. So all of our disagreement is going to be to the left of that red square. So what I did, as you've kind of learned from the other speakers, is I collected new 19th century data. I have stock and bond returns from January 1793. And a couple things I did that were different and novel. First of all, I found the share counts. Second, I found the dividends. Jeremy, working in the early 90s, he had no dividend data. He had to estimate what the dividend yield was. Because I have share counts and because I have dividends observed, I developed the first capitalization weighted total return index on stocks. The other unique part, as you'll see here, is that I observed bond prices. Before I wrote, people extracted returns from yield series. Not quite the same thing. Now, we are going to go back way, way in time. If you're a native New Yorker, you've seen engravings like this, the broad streets, the cobblestones paving, the three-story houses, the porter pushing the wheelbarrow. But maybe what you have not noticed before are the pigs running wild in the street. Because that was the habit in North American cities of that time. The pigs were unpaid janitors and garbage men, much to the disgust of our English visitors at that time. So come with me back to a time when pigs ran free on Wall Street. With some audiences, I have to have a flashing yellow light there. Good thing. All right. But no matter how far back you go in time, in American newspapers, you will see stock price quotes. There's two examples from 1815 and 1830. They were just news items. They were mixed in with the marriage notices and the death notices. What was being quoted changed, but as far back as you can go, you see stock prices in the newspaper. Now, eventually, I had to get data from the four major markets: New York, Boston, Baltimore, and Philadelphia. Over a period of some decades. And thank God for Richard Silla of New York University, okay? Because he sent an enormous research team into the archives, and he got all those stock prices. He put them in a spreadsheet. He virtually handed them to me, okay? All I had to do was curate the series. But the Scylla database reports no share counts and no dividends. Now, you can't read this, even on the big screen. That is deliberate. This is what a newspaper page looked like in the 1830s. 6 columns of tiny print, the old Wall Street Journal broadsheet size, 4 pages of that. And you're looking for the dividend notice. My great advantage was I came late to the party. Everything had been digitized. And so I could say, oh, there's a little green highlight down there in the bottom right corner. Little magnification, and we discover that the president and directors of the Tradesman Bank have declared a dividend of 3.5% on the capital stock for the 6 months ending 31st instant. Okay? So that's really all I had to do post-digitization, year by year, city by city, stock by stock, grab these dividends and put them in my spreadsheet. You didn't see any share counts on that slide. Okay. For that, you have to go back to digitized almanacs and directories. Cities bragged about their capital at that point. New York Bank of New York, $1 million. Manhattan Company, 2.05 million. Merchants Bank, 1.49 million. And the share prices. After much tedium, I had built a new historical record from the ground up. I have the returns on stocks and bonds from 1793, prices, dividends, and share counts, coupons, and trade prices. So, what does the new history show? Well, I'm going to work backwards, which you almost never see in these kind of long term charts. Blue line is real stock returns. Orange line is real bond returns. This is the last few decades reset at 1982. And, well, what do you see? Stocks and bonds perform about the same. But go back to the previous 40 years. Stocks wipe the floor with bonds. Remember, that's a log scale vertically. That is a 34x wealth advantage, most of it in the 20 years immediately after World War II. This is where the delusion of a permanent, durable equity premium got its start. So if I played my slides right, you are aching to see what happened in the first 150 years. Does it look like the lines on the right? Or does it look like that enormous spread in the red square? Well, that's the new historical record from 1793. Up until the 1940s, it was a neck and neck horse race for 150 years. And then stocks wiped the floor with bonds, giving rise to the illusion of a durable, persistent equity premium. Now, uh, to compare my chart to Jeremy's, it's really very simple. I have lower stock returns before the Civil War. I have higher bond returns after the Civil War. That was sufficient to pinch the lines together and keep them zipped to the 1940s. Well, folks, you're going to have to decide who to believe. Okay? On the one hand, we have Jeremy Siegel, PhD, MIT, a student of the great Paul Samuelson. First job out of school, University of Chicago. Holds an endowed chair from one of the best business schools in the world. And on the other, you have Edward McQuarrie, who in the present context is a very close approximation to nobody. Who are you going to believe? I'm afraid to hold up my end here. I'm going to have to violate a scholarly norm and go negative. Not on Jeremy Siegel. He is and always has been a gentleman and a scholar. I'm talking about Jeremy's terrible, horrible, very bad, no good data sources. He started with Smith & Co. 1935. They collected prices on dozens of stocks, all the same stocks Richard Silla had, all the same stocks I have. But they were after something different than total return. What they did was they charted the price action of all these stocks on transparencies, stacked them on a light table, and one by one threw away all the discrepant movers. So you had the Second Bank of the United States, the largest single stock of the time. Its chart looked like this. Okay? They threw that one right out. We are talking a recipe for survivorship bias. Okay? They left out all the bad stuff. Now, with bonds, it's a little bit different. Jeremy has his bond series from Sidney Homer's History of Interest Rates, who got it from Frederick Macaulay's book, who got it from Joseph G. Martin in Boston, publishing in 1898. This is the New England Municipal Series. And what McCauley did. I was trying to think of a polite academic term for made up out of whole cloth, and I settled on constructed, okay? Uh, so basically, the actual observed yields didn't come out the way Macaulay wanted, so he just kinda lowered them for the first few decades. Poor Jeremy came along and computed returns from those falsely low yields. In summary, 19th century US was different. Bad data led to the mistaken conclusion that stocks had always beaten bonds. Recency bias reinforced the mistake. Now, we have Elroy Dimson here, the master of all things international. I only allowed myself one slide, international. But I got to thinking after the 19th century US data, I knew somebody was going to say, are you going to put any value on that pre 1871 data? Maybe I better check internationally. Okay. And indeed, when I went looking at 20, 30, and 50-year rolls, I found equity deficits in 19 out of 19, 18 out of 19. Hold on for 50 years and the bonds still win in 12 of 19 cases. So, under the new market history, sometimes stocks beat bonds, sometimes bonds beat stocks. Much of the time, even over long intervals, it's a horse race. Now, folks, I'm proud of the digging and the research I did, but in all honesty, I don't think it would have been enough to publish in the Financial Analyst Journal. Fortunately, I had editorial assistance from Will and Lewis. It looks more like a silk purse now than when it started. Okay, um, and they helped me step it up a level. Are you ready to step it up a level? Yeah. Okay, let's translate. Yeah, it jumps around a lot. Now you see it, now you don't. Maybe stocks do well, maybe they tank. Non-stationary process. Now, Jeremy and others criticized the bond data in the FHA paper. I had included corporate bonds since they did dominate the fixed income space in the last half of the 19th century. But okay, I get it. So I collected a new government bond index monthly, figured out how to transform my annual stock data monthly. And now we're going to look at a more fine grained analysis of these actions. So this is the 10-year observed equity premium. There's about 2,600 bars in this chart. That's why it doesn't look like a bar chart. Okay. Red is deficits, green is equity premia. And as you can see, before the modern period, equity deficits were practically the norm. In fact, that blue cumulative line doesn't turn positive until after 100 years. Now, it's not just returns that fluctuate. Other inputs to asset allocation have also not been stationary. This is the trailing 120-month correlation for any of you who maybe have done a Markovitz asset allocation. This is how stable the correlation has been over the centuries. It hovered between zero point 0.2 and zero point 0.4. Then all of a sudden in the 20th century, it plunged. Then it plunged further. Then it plunged down to about minus zero point 0.5, reverting very quickly in all cases. Not very stable. Yeah, this one looks like a rude gesture. Okay. What we have here is stock and bond volatility, again, over the trailing 120 months. And as you can see, 1929 to 1933 was completely different. And what that has unfortunately meant is that Roger in the SBBI yearbooks, of course, has to include 1926 forward. I've been reading those books for decades, and the stock standard deviation annually has always been zero point 0.2, but that's very much driven by 1929. Either side of it, you get a deviation more like 0.15. So to summarize part two of the talk, stock and bond returns jump around. Correlations are all over the map. Volatility waxes and wanes. You ready to step it up another level? I haven't published this stuff yet. It's absolutely fresh off my desk. Okay. And what I'm going to try to do is, as it were, falsify what I just told you. I'm going to try to restore stationarity at a higher level of abstraction. Most of the speakers will recognize the name Edgar Lawrence Smith. 100 years ago, he wrote a book titled Common Stocks as Long-Term Investments. He was kind of the Siegel, okay? And Jeremy properly acknowledged him in his books. Probably the first to compare stock and bond returns over long intervals, and concluded, you'll recognize, every test except one shows better results are obtained from common stocks than bonds. Huh. Well, more particularly, the conventional wisdom of Smith's day held to a two-sided hypothesis about stock and bond returns. At the time, in the early 1920s, they had the perfect test case. The black line is prices. Deflation for decades after the Civil War, turning around in 1897, and all the prices had come roaring back by 1922. Conventional wisdom was you have deflation, bonds win, those coupons are worth so much more, stocks tank because prices keep falling. But under inflationary conditions, it's the reverse. So this was actually what Smith set out to test. And he felt, this is why he published his book, that he had overturned the conventional wisdom. No, stocks win, inflation, deflation, whatever. Well, as I think most of you know, I am a retired professor. I have time on my hands. So I could go back to Smith's appendix after page 120 on this 100-year-old book and say, let's take a closer look. He sandbagged them, okay? He deliberately set it up so that the bonds in the deflationary period would look not so good. Which got me thinking, hey, I've got bond data back to 1866. I've got stock data from the Cowles and from Crisp rather, and I found that the conventional wisdom was right. Stocks underperformed in the gray area. That once reset at the end, they outperformed under inflation. Well, that's interesting. I found another sustained deflation in the historical record. This hinges at 1843. And what we see here is again the red line tanks in the gray area, surges ahead of the blue line as inflation resumes. And then finally, we have the last deflation in the U.S. record, 1921 to 1933. Same pattern, bonds win under deflation, stocks win under inflation. Well, I'm older now, and I know not to just present charts. I know to present statistical significance tests. So, the obvious candidate for a two-way analysis of variance. I've got 71 deflation years, 63 adjacent inflation years, and I find indeed a significant crossover interaction between type of price change and type of asset, stocks versus bonds. A picture is worth 1,000 words. Here is the crossover interaction. Blue line up under conditions of deflation, blue line down under conditions of inflation. Now, I added back all the excluded years, I combined disinflation years with the deflation years, and once again, the crossover interaction is there. And most interesting to me, you take a raw look at the 230 years and you can do a statistical t-test, stocks beat bonds. Once the interaction is taken out of the variance, that's a non-significant main effect over the 230 years. Good news for anyone who's going to be sitting for the CFA exam, two-way analysis of variance will not be on it. Okay? But you darn well better know your regression analysis. So I'm going to look at the annual EP and regress it on various factors, and I'll more particularly look at a hierarchical regression. More on that in a minute. First of all, here's the scatter plot. Equity premium on the vertical axis, price change on the horizontal axis. 10 seconds, everyone. Take a look. Keep your answer to yourself. Is there a significant linear trend line in this scatter? Correct. Yes, there is. But under a more exacting examination, this notion of a linear relationship between the equity premium and inflation proves to be a misspecification. Oops, lapsed into academese again. The shorthand version is fail. Okay. What I've done in this chart is I marked out the positive from negative EPs with the horizontal line. I've got the deflation minus 2% on the left. And what turns out is that trend line is being driven by what's happening to the left of the line. Lots of negative EPs, not too many positive. Look to the right, it's a scatter. So what we're going to do at this point is we're going to treat deflation as a thing, not as the bottom of a price change variable. And with annual equity premium as the dependent variable, I find indeed deflation has a significant beta negative on the equity premium realized. Now, the game with hierarchical regression is you take your best theoretical shot first, and then you see if anything else can make it into the regression. So first thing I add is the exact quantity of price change, D nada. Next, I distinguish the gold standard years before 1934, D nada. Then I give a dummy variable for high inflation, D nada. Then for change of inflation, nothing. Deflation is the single best predictor I had for the annual equity premium. So we have stationarity restored. It's stocks for the inflationary run, bonds for deflation and disinflation. I basically kicked non-stationarity upstairs. It concerns the incidence of deflation or disinflation. They were much more common in the 19th century. That's why the 19th century looks so different. All right, now what? I think I have 5 minutes left. Who's got? Oh, thank you, Jeannie. All right, now what? No author is responsible for what the bottom half of his readers do with his work. Okay? The bottom half of Jeremy's readers read the book and said, I get it. Held for decades, stocks are as safe as a bank deposit, but they pay at a higher rate. Jeremy never said any such thing. Okay? But that was the takeaway for all too many readers, to which I want to say, no, no, no. Stocks are always risky. Now, here's what the bottom half of my readership takes away. Okay? And let's see. Oh, I do have a couple minutes. No. I think stocks are a good wager. They're a good bet. Okay? No, I don't think you should own any more bonds. I don't own any bonds anymore, except TIPS and that turbocharged stable value fund known as TIAA Traditional. For the rest, it's all stocks. Okay? Now, that's not the implication of my research. Oh, this one surprised me first time I presented something. No, international stocks are not better than U.S. stocks. They're not worse than stocks. They're just a diversifier. Spread your bets a little bit. Sometimes the one will win, sometimes the other. In conclusion, the truth about market history is not so reassuring as a naive reading of Siegel might suggest. Post-1926 U.S. history has seen superb stock returns, but a more complete history that extends backwards in time and looks outside the U.S. gives a darker view. Stocks remain risk assets on any time scale. Thank you.
Well, you guys are a hard act to follow. Do you want to come? You want to come up? I don't have that much to say, and I know you guys probably have rebuttals of various sorts. Okay, let me just show one picture, and just to brag about the fact that I go back longer with my data than any of you guys. You're never going to find a stock that you can track back to 1372. So, this is a picture of the Basel Company. It's one of two companies that were created in Toulouse in 1372 and 1374, just right in the middle of the 100 Years' War between France and England. And my co-authors, I have one co-author in particular, David Labrise, who spent a lot of years in the archives gathering data for this both companies. What you're looking at here is just the tail end of the data that go from 1532 up to 1949, when the company was nationalized. Didn't go bust. The French government just decided in its wisdom that this many century old company should be owned by the government. Now, actually, then it privatized it, so you can go out and buy shares in the same company that's been around for 300 years, for 600 years. So it's an interesting thing. Yes, you might. Okay, Ed, you're going to say survival bias, but I'm not even going to listen to that. But what's fun about this is you have two axes. One is the red axis on the right-hand side with the price of the shares of the Basel Company. By the way, it's a mill company. It milled grain, and it was a substantial, pretty big firm. And its rival upstream was also a big firm. Toulouse was the breadbasket of southern France, a big marketplace there in grain. Anyway, long story, a little bit longer. What you can see here is also the dividends, and the dividends are in blue. So you can see the 200 and 2000, that relationship there. Now, we put all the dots of the dividends that the company was paying and the prices dots. And well, first thing is, you got to say, stocks are risky. This stock was risky, bumped around quite a bit. You can see secular changes, which is what Ed has been talking about, shifting relationships, greater drift forward and drift upwards in stock prices after 1750, actually after 1700. You see a few points where the company went bust and had to be recapitalized. Those are a couple of gaps there. So this company didn't have a smooth ride. It actually didn't survive because it was nationalized, as I say. But one of the things that's really interesting about it is when you run 20-year moving averages through the dividends and through the prices, you see a strong relationship. So, back to Bob, friend and co-author, but sometimes big disagreements as well with Bob. You see a structural relationship between the dividends and the prices that people were paying for them that go all the way back long before somebody wrote down any kind of growth model, or for that matter, this relationship certainly precedes the perpetuity formula before it was derived. So, the markets were figuring things out. So I'm going to just leave that graph there. and ask Jeremy for his thoughts and reactions, and you can start it off, and we'll get a sign when it's time to stop.
Thank you. Thank you, Will. Thank you, Ed. As I said, hey, we wouldn't have flowers grow unless someone got into the weeds as you do with all of the. And I didn't know the Second Bank of the United States, the First Bank of the United States wasn't included in the series. It did go down. What percent of the portfolio was 30%? So yeah, but that was 7 stocks. That was one stock I guess we didn't. I guess the only thing we ever had since was the AT&T before it got broke up.
I didn't hear that last.
AT&T before it got broke up was
Mhm.
20 or 30%. It's one reason. Okay. A couple of things I like to, and I'm sure we'll all get into a discussion on this. It was interesting on inflation or deflation. Now, many people in this room are certainly wondering about how they should allocate their portfolio into the future. Let me ask you, Ed, do you think, given our uh, government's current fiscal situation, inflation or deflation is most likely in the future?
Oh, I don't think you need to look at our government's deficit. You simply have to go back to 1934 and the advent of fiat currency. I'm not sure that deflation is even possible under a fiat currency with a bank. So if one were confident that neither deflation nor disinflation will ever return, stocks for the long run.
Okay. um, so our current situation going forward would tend to be more favorable to stocks.
I think almost any reasonable person would agree.
Okay. Um, um, secondly, um, I noticed quite a number of your slides in let's say 2019, 2021. Things have not been great for bonds since then, have they?
Well, remember, Jeremy, I don't think people should own more bonds.
Oh, I see.
Okay, I said that.
Well,
All right, and now the cutoff in the data there. Remember, on the right side of the red square, we're using the exact same sources. Okay. All of my dispute with Jeremy concerns what was to the left of the red square, the before 1926 data. As I told you at the beginning of my talk, I've got no clue what the equity premium will be going forward. I believe Jeremy does have a clue.
I have an estimate. Uh, I'm not. That's all. I'm not betting my wife here. Let me ask you. You were so kind to come to the Securities Industry Association. We invited you and gave a great address. This was 2019, and we took a vote, didn't we? Afterwards, how would next 10 years? Who would rather be in stocks or bonds? Of the group there, and we're not a fixed income people there. Now, the group did grow 90% for stocks, but there's almost no way that that group is going to lose as a result of what's happened to bonds. Is that correct?
I remember that day a little differently.
Oh,
I remember being invited to debate with Jeremy in an executive education class. And I remember the question being, who you gonna believe? The guy who's been teaching you for the last week or this newcomer who just flew in from California? And it was 95% for Jeremy.
no. Ed, you have an inferiority complex.
Well, there's
No, you've done a wonderful job here. I'm just saying that, bonds have done, you're talking about one period. Bonds have done quite dreadfully over the last 5 years.
2022 was the worst bond market in history.
And that worst bond market in history is not in your FAJ article. Is that correct?
That is correct. Nor it is in the monthly data that I showed you in the second set of slides.
Okay. You say that you show that square 1926 to the present. You don't have any question on equities. Do you have a question on the Coles Foundation or from 1871 to the present?
Not on stocks.
Okay, not on the stocks.
Jeremy mentioned, I did manage to budge the Coles index after almost as much tedium as what I showed you here. And you know how much I budged the Coles equity index after years of working? I think I got it down by 16 basis points. So I might have said
there is no
there's no
debate
disagreement
about
equity.
there's no debate over the last 154 years of stock returns.
For stocks, there is.
Okay, just a minute. Yes, but I don't just want to get stocks first. Okay. No debate about what the last 154 years of stocks returns are. There is certainly a debate. Not a debate. I concede that stock returns are not as good as I presented from 1802 to 1871. Everyone out there has to make a decision in thinking about future stock returns, whether Edwards' research, which lowers the real return on stocks from 1802 to 1871, it impacts their estimate of what stock returns will be in the future.
Jeremy.
Time up. One more thing. No. Am I stating a fact or not? I'm not. I'll let everyone make their own conclusion on that statement. Is that a fact?
You don't want to draw the line at 1871.
Well, I do.
I mean, when you start,
But I draw the line at
Is-
1871.
you draw the line at 2007. I mean, everything before the
No.
introduction of the iPhone is historically irrelevant, all right? Unless you want to draw the line at fall 2022, because before ChatGPT, I mean, metal benders, packaged goods manufacturers, who cares what their stocks did?
Okay, and one last thing. The risk-free rate. There really wasn't a nominal risk-free, really. I mean, probably, right. Now there is a nominal risk-free. And when we talk about the equity risk-free, we're comparing it with governments that in nominal terms will always perform. There's no way the Fed can print the money to do that. I certainly commend that you are in tips. I'm in tips too. Not trusting what the government going forward. So what I would do is saying, as we're going forward, would you say that the real returns on bonds are more like the bonds that we have in the 20th and 21st century, or more like the bonds of the 19th century?
Depends on whether deflation recurs.
And your statement was extraordinarily unlikely.
I agree.
Thank you.